If you had invested $10,000 in the equal-weighted S&P 500 in 2015, you'd be sitting on just over $25,000 today. But if you'd invested the same amount into the tech sector instead, you'd have over $63,000 today. That's an annual growth rate of 20.4%, double the yearly return on the equal-weight S&P. Since April, tech has more than doubled the returns of the equal-weighted S&P. What makes that massive rally even more impressive and more precarious is that it was driven by just a handful of companies, 7 tech juggernauts that literally move entire markets on their own. This chart shows how market concentration has changed over the past 100 years. The S&P 500 today is the most concentrated it's been since 1932, and that could be a major vulnerability in the stock market. So, could the immensity of the Mag 7 break the stock market, or will it continue to drive the stock market even higher? That's what we'll explore in this video. These companies are known as the Magnificent Seven. They're Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and Nvidia. And together, they make up 32% of the entire S&P 500. These companies have driven this historic rally on the S&P 500 since 2023 with their strong fundamentals and high profits, but they also contributed in a big way to the near-bear market earlier this year after the tariff announcement. When those giant companies are weakened, they can take the rest of the market with them, like we've seen recently. So how vulnerable are the Mag 7 companies to Trump's tariffs, and what might happen when the pause on the tariffs is lifted? First, let's look at what makes the Mag 7 so vulnerable to tariffs, and what that could mean for these companies as the trade war continues to play out. Taken as a whole, the Mag 7 is very sensitive to tariffs because it's exposed to foreign markets in terms of manufacturing and revenue. Every Mag 7 company has manufacturing and sales ties to foreign countries, primarily China, Vietnam, India, and South Korea. In fact, around 3/4 of the Mag 7's suppliers are overseas, and 5 out of 7 of these companies earn the majority of their revenue from abroad. But the biggest threat comes from the trade war between the US and China, because China is, unsurprisingly, where these companies have the deepest ties. For example, up to 90% of Apple's iPhones are currently made in China, and the US has slapped a 145% tariff on imports from China. If tariffs do go into effect on smartphones from China, then the cost of producing iPhones could jump by hundreds of dollars, and Apple could see a 20 to 40% dip in earnings, which would weigh heavily on its stock price, which has taken a big hit this year already and is down over 20% from last year's highs. Tesla is another Mag 7 company with heavy exposure in China. The electric car behemoth has a gigafactory in Shanghai, where it produces vehicles for the domestic markets and for export. And while Tesla hasn't been hit as hard as other car manufacturers, thanks to their relatively domesticated supply chains, Musk has said that Tesla is not immune to the tariffs, and the company's bottom line has taken a hit. But despite the Model Y already being the most American car, produced largely in the US, 30 to 40% of Tesla's car parts are still sourced from abroad, so that alone makes their pricing exposed to the effects of tariffs. And then look at Nvidia. The chip giant has deep ties to Taiwan, where its US-designed chips are manufactured. Trump's Liberation Day tariffs included a 32% levy on imports from Taiwan, and that would impact Nvidia. Shortly after, though, Trump announced a tariff exemption for chips, which seems to have saved Nvidia from the worst of it. The flip side to this is that tariffs go both ways. So a lot of these other countries will hit back with their own tariffs, and this will take a big hit on revenue for companies with foreign market share. Let's look at Nvidia again. Up to 30% of its revenue is tied to demand from China, so reciprocal Chinese tariffs would make these chips more expensive and reduce demand, cutting into Nvidia's profit margins. And Nvidia isn't alone. Take Apple. The Chinese market accounts for 20% of its total revenue, so tariffs and other restrictions could make a major dent in Apple's balance sheet. But despite these vulnerabilities, the Magnificent Seven also has some strengths which make some of these companies resilient to tariffs. Some of these companies have a heavy domestic revenue base. Amazon leads with around 70% of its revenue coming from North America, and Microsoft earns more than half of its revenue from the US. That gives these companies a leg up when it comes to weathering tariffs and maintaining healthy profits. And it's not just where these companies are making sales that matters, but also what they're selling. Tariffs mostly affect hardware, chips, iPhones, physical products, but many of these companies primarily trade in software and services, which are not usually subject to trade barriers. For example, look at Amazon. More than half of their revenue comes from Amazon Web Services, giving them a significant cushion against tariffs. Cloud services like Microsoft Azure and Google Cloud also bring in significant revenues without being subject to tariffs. And as for Meta, ads provide 99% of the social media company's revenue, and ads are not affected by tariffs, at least not directly. But Meta could be indirectly exposed to tariffs. This could, in turn, make a significant dent in Meta's earnings. But one of the Magnificent Seven's biggest strengths is just their sheer size and dominance. These companies enjoy massive brand recognition and loyalty from their customers. For that reason, they can afford to raise prices more than most companies without losing market share. For example, Apple has raised the price of their iPhones multiple times without losing sales. And lastly, most of the Magnificent Seven companies have massive cash reserves and margins to lean on when times get tight. Looking ahead, this means that as the tariff pause comes to an end, Mag 7 companies stand to take a big hit and bring the market down with them. But they're also well positioned to weather the storm in the grand scheme of things. And they're already making big moves to insulate their profit margins from the disruptive and unpredictable nature of the trade war, which shows no sign of slowing down. At Capital.com, we'll continue to keep you updated on the latest market trends, providing you with the insights you need to make smart trades. Thank you for watching.